Hi, in this video I'll explain monetary policy. Along with fiscal policy, monetary policy is a demand-side policy, meaning that the main aim and objective of the policy is to impact aggregate demand. Monetary policy is carried out by the central bank. The central bank does this by changing the amount of money which is supplied in the market, which in turn has an impact on the interest rate, on the amount of investment, and the aggregate demand in the economy. First, let's define interest rate. Interest rate is the cost of borrowing and the reward for saving. When the interest rate increases, the cost to borrow also increases, discouraging firms and individuals from borrowing money. It also increases the reward for saving, encouraging firms and individuals to save rather than spend. A lower interest rate lowers the cost of borrowing and the reward for saving. A lower interest rate will encourage consumers and firms to borrow more and save less. The central bank can impact interest rates by changing the amount of money which is supplied in the market. There are three very important diagrams to understand to be able to explain monetary policy. The first diagram looks at the relationship between the quantity of money in a market and the rate of interest. Notice that on the x-axis is the quantity of money, and on the y-axis is the rate of interest. Also notice there's a downward sloping demand curve, which is the demand for money, and a perfectly inelastic supply curve, which represents the supply of money. It's perfectly inelastic due to the fact that there's only a certain amount of money that can be supplied in the market at any one time. If there was an increase in the supply of money in the market, it would shift the supply curve to the right, increase the quantity of money in the market. It would also reduce the interest rate. This leads us to our second diagram. With a lower interest rate, consumers and businesses are encouraged to invest more, as the cost of borrowing has decreased, and the reward for saving has also decreased. In our second diagram, notice that the x-axis represents the quantity of investment in the market. And at a lower interest rate, consumers and businesses will invest more. This in turn has an impact on aggregate demand. Remember, aggregate demand is a combination of demand of consumers, businesses, the government, and foreigners. When businesses and individuals increase their investment spending to purchase capital equipment, houses, cars, and boats, aggregate demand will shift to the right. This is called expansionary monetary policy, and it's done in order to close a recessionary gap. Notice that the amount of output at YREC is less than the amount of output at YP, or potential output. The increase in the supply of money in the market has led to a lower interest rate, more investment spending by businesses and firms, and a right shift of the AD curve, and a closing of the recessionary gap. Now, there's more output, income, spending, and employment in the economy. And there's also a bit of an increase in the average price level. So how does the central bank increase the supply of money in the market? The central bank has three methods at its disposal to change the supply of money in the market. The central bank could lower the discount rate. The discount rate is the interest rate the central bank charges to commercial banks when commercial banks borrow from the central bank. So a lower discount rate will encourage commercial banks to borrow more from the central bank. This will give the commercial banks more money which they can lend. It will increase the supply of money in the market, decrease the rate of interest, increase the amount of investment by consumers and firms, and also increase aggregate demand, closing the recessionary gap. A second option for the central bank, in order to increase the supply of money in the market, is to buy bonds. Commercial banks will hold bonds or government debt, and the central bank can buy that debt or those bonds back from commercial banks. This will give the commercial banks cash in exchange for their bonds. More cash means more supply of money in the market, a lower rate of interest, increase in investment from consumers and firms, and an increase in AD, closing or reducing the recessionary gap. A third tool at the central bank's disposal is lowering the reserve ratio. The reserve ratio is the amount of cash banks must hold compared to the amount of cash that they lend. Imagine that a commercial bank had loaned $1 million to its customers. Imagine a reserve ratio where the bank had to hold $2 for every $1 it lent out. In this situation, a bank which had lent $1 million to its customers would have to have $2 million on hand. By lowering the reserve ratio to 1-to-1, the bank would be able to lend out $500,000 more dollars. By lowering the reserve ratio, there's a greater supply of money in the market. The increase in supply decreases the rate of interest, increases the amount of investment, and also increases aggregate demand, shrinking or eliminating the recessionary gap. But what if the economy finds itself in an inflationary gap, where the amount of output exceeds the potential output in the economy? In this case, the central bank would want to try to reduce aggregate demand. And they could do this by reducing the supply of money in the market. Here's how it works. Notice that a left shift or decrease in the supply of money will cause a movement up the demand for money curve. This will also create a lower quantity of money in the market and a higher rate of interest. Remember that the higher rate of interest will discourage businesses and individuals from borrowing due to the fact that there is a rise in the cost of borrowing and also an increase in the reward for saving. The increase in interest rate, therefore, will cause a decrease in the amount of investment. When consumers and businesses demand less investment, since they're part of AD, this will decrease aggregate demand. It should also eliminate the inflationary gap. It will also reduce average price level, the level of output, income, and employment. So how can the central bank decrease the supply of money in the market? The central bank can raise the discount rate. In doing this, the amount of interest they charge to commercial banks now goes up. Commercial banks will borrow less from the central bank, leaving a lower supply of money in the market, an increase in interest rates, a decrease in investment spending, and a decrease in aggregate demand. The central bank could also force commercial banks to buy government bonds, meaning that there would be less supply of money in the market, a rise in the rate of interest, a decrease in investment, and a decrease in aggregate demand as well, reducing or hopefully eliminating the inflationary gap. Finally, the central bank can increase the reserve requirement. Imagine a bank with a 1-to-1 reserve requirement. It's lending $1.5 million and it's holding $1.5 million in reserve. An increase in the reserve requirement would force the bank to lend less and hold on to more money in its reserves. This will cause a decrease in the supply of money in the market, an increase in the rate of interest, a decrease in investment spending, and a decrease in aggregate demand. Let's discuss the benefits of monetary policy. The central bank is an organization that is separate from the government in many economies. In fact, central bank members are appointed by government officials, not elected. This gives them some independence to make tough decisions that might not be very popular with the general public. And this is a very important advantage compared to fiscal policy. When the economy is facing an inflationary gap, fiscal policy would try to correct it using increased taxes and decreased government spending. These two policy measures are very unlikely to happen in the real world because politicians want to become re-elected. Due to the fact that central bank officials aren't elected, they can choose to raise interest rates and not have to worry about a backlash from the public. This is a much more effective way of decreasing an inflationary gap compared to fiscal policy measures. The central bank can also change interest rates in very small increments, meaning that they can fine-tune the economy with slow adjustments and changes to the rate of interest. One of the disadvantages of monetary policy is the inability of lower interest rates to necessarily encourage borrowing, especially during a deep recession. In a deep recession, fiscal policy, specifically government spending, is probably a more appropriate option, as it has a direct impact on aggregate demand. Also, much like fiscal policy, monetary policy does not do a very good job of fixing the problems associated with supply-side issues. Remember that when aggregate supply decreases, there's an increase in price levels and a decrease in output. If monetary policy was used to try to decrease price levels, it would lead to an even further decrease in output. And if monetary policy was used to try to increase output, price levels would rise even higher. Some governments use monetary policy as an automatic way of controlling inflation. In these circumstances, the government will set inflation targets. For instance, between 1 and 3% inflation rate. And if inflation falls outside of that range, monetary policy will automatically be used to pull the rate of inflation back within the range. In this way, the government's priority is to focus on inflationary pressure, meaning that all other priorities or government aims take a back seat. For instance, if there was an inflationary gap, monetary policy which would be used would increase interest rates, even though it will decrease economic growth and the rate of employment. When evaluating, government priority can be an important point to make. Another important evaluative point has to do with the price elasticity of demand for investment. During deep economic recessions, individuals and businesses won't be very responsive to changes in interest rates, as they're worried more about their future than borrowing money. Therefore, they would rather save than spend. Another point to remember is the difference in the change in AD depending on the macroeconomic model which is used. For the Keynesian approach, a drop in aggregate demand will cause a drop in the output of an economy, but a relatively smaller drop in the average price levels. This is due to what Keynesian economists call sticky wages. Because of minimum wage, worker contracts, and the power of unions, so when output drops, cost of production won't drop at the same rate, especially the cost for labor. Therefore, firms will need to get rid of or fire workers to cut costs, creating an even further drop in output. The monetarist New Classical approach, however, describes a drop in output being matched by an almost equal drop in average price levels. This is something else you should consider when thinking of the impact of monetary policy on the economy. Linked in the description is a worksheet that you can use to help consolidate your knowledge even further. If you found this video to be useful, please like and share it. Also, please subscribe to the channel. And finally, it's dad joke time. Inflation is important because it allows you to live in a more expensive neighborhood without moving. Thanks for watching. I'll see you again next time.